Corporate Finance Presentation, Bond Prices, Yields, and Ratings. Get ready, it's time to take your chance with Corporate Finance. Bond prices, yields, and ratings. Financial managers must monitor bond markets closely for changes in interest rates and price movements. Market conditions will influence the new issue timing, coupon rates offered, and maturity dates. So in other words, if we are a corporation, we're looking to finance corporation operations with debt through the issuance of bonds, we want to make sure that we're getting the optimal terms on the bonds, and timing will be important to get that. So market conditions, the market itself, will influence the corporation's decisions as to the new issuance timing, when we're going to send out the bonds or issue the bonds, the coupon rates that will be offered, meaning the rate on the bond that we're going to have to offer is going to have to be in alignment to some degree with the market so that we can actually issue the bonds onto the market. That coupon rate will, of course, help to determine how much we're going to have to pay to finance the bond in the format of interest. And then maturity dates, which will also be important, be key, because if there's a lot of fluctuation in the interest rates and whatnot, we have to make the determination as to whether we want a shorter term bond or longer term bonds with regards to how stable the market conditions might be. So bonds generally do not have stable long-term price patterns. So we have to take into consideration market movements as we go. The longer the issue life, the greater influence of interest rate changes on the bond price. So if there's going to be changes in the interest rate, of course, that will change the bond price. But if you change the interest rates on a bond that's going to be longer in time period, then of course you've kind of locked into the interest payments for a longer period of time. And those then, the changes in the interest rates will have a more significant impact for those longer term bonds than possibly for the shorter term bond. So bond yield calculation. So we have a couple kinds of calculations here. We've got the coupon rate or normal yield. That's just simply going to be the stated interest payment divided by the par value. Note that the coupon rate or nominal yield isn't taking into consideration any market conditions really. It's taking in information strictly on the bond. So we have the stated interest payment, which you can calculate from the information on the bond, and then the par value or the face amount. Then we have the current yield, which is taking the stated interest payment, the amount of interest that would be calculated out, divided by the current price. Now this one is taking into consideration some market conditions because the current price is not on the bond, it's determined by the market. So now we're looking at basically our return, our yield, and this would typically be on an annual type of basis. We would be comparing the interest, what we would get back on an annual basis, versus the current price to look at our return. This is useful, but it doesn't take into consideration the long-term impact of the bond as would be the yield to maturity. So the yield to maturity is usually more accurate or a better judge of the full perspective of the investment, given the fact that you have a series of payments and you have the face amount at maturity that will also be included, which really isn't taken into consideration when you look at simply the current yield. So we'll do practice problems and compare these out so you can see these differences as well. So we highly recommend working through the practice problems so you can understand this better. But the yield to maturity you could basically think of as the market rate, the interest rate that will equate future interest payments and payment at maturity to the current market price. So we'd be looking at the rate for which, if we were to calculate the present value of the annuity, the interest payment using that rate, as well as the present value of the face amount that would be received at maturity, we would come up with the face amount or the par value of the bond. That rate would be the yield to maturity. Now, we did some calculations to calculate that in a prior section where we focused in on calculating the bond price and the yield to maturity in more detail. So if you want to work through that calculation in more depth, you can take a look at that section. We will do some practice problems on this as well as we compare, for example, the coupon rate, the nominal yield, the current yield, and the yield to maturity. We will have kind of a new calculation here, which will be an approximation yield to maturity. So we'll do the actual yield to maturity, and in this section, we'll focus more on that in Excel, using Excel functions when we go to the practice problems. And then we also have this formula that you could use to get an estimate of what that will be. This could be useful in practice, although in practice you probably have access to something like Excel. It might be useful for you to better understand what the calculation will look like, what you're actually doing with the calculation. And if you're in a book problem, you might see this in a book problem. If they try to take away your Excel and your financial calculator and they force you to do it with a formula, then you may be forced to, learn this formula and do it in that sense as well. So we have the annual interest payment plus the principal payment minus the price of the bond divided by the number of years to maturity. All of that over 0.6 times the price of the bond plus 0.4 times the principal payment. So we will do some calculations with this formula as well and see how close it is to the actual calculation of the yield to maturity. Note that if you are using a book problem where they force you to use a formula like this, even in a multiple choice question, they can test whether you use that formula or not due to the fact that the answer will be slightly different than the actual number because of that rounding of the example. Also note that I have seen this formula formatted in another way as well, which looks to me like it's not quite as accurate most of the time, but you might see it often too when you're looking at this approximate calculation. That would be the price of the bond plus the principal payment divided by 2 on the denominator, as opposed to 0.6 times the price of the bond plus 0.4 times the principal payment. In other words, once again, you might see the price of the bond plus the principal payment divided by 2 in the denominator of this whole thing as an alternative, and we'll test that out as well in our practice problems. So bond ratings are based on, or in other words, when we think about corporate bonds and how they're going to be interacted with the market, there's a tool, and rating agencies will typically be used, and the rating agencies will help to categorize the risk that will be related to the bond, which helps markets to then determine what they think the rates should be or what the returns should be with relation to the bonds. So the rating agencies will help the allocation or the connection between the investors and the issuers of the bond by hopefully providing more transparency to the level of risk that is being taken on, so that the market can assign a more appropriate price given the information in the market, also providing more information to more people in the market. And again, if that information is trustworthy, then of course that should help to facilitate transactions, help to facilitate capital flow. So how do the bond ratings work then? So the bond ratings are based on the ability to make the interest payments. So just like with a bank, of course, if you were to take out a loan, they're trying to say, hey, can you at least pay the rent on it? Meaning, they want to make sure that you're paying the interest payments, because as long as you're paying the interest payments, then that's the minimum. You should be basically okay. So that's the first thing you kind of want to be looking at. And the bonds, same thing, right? These rating agencies are going to be looking at it, and they're going to be determining, is this company going to be able to pay back the interest, at least the rent of the money that are on these bonds? The size as well is going to be an impact in terms of the rating, the consistency of the performance. So just like if you were to go to the bank and try to get a loan, they're going to say, hey, how have you done in the past and whatnot? What's your past performance look like? The debt to equity ratio, the working capital position. Now, obviously, these rating agencies are highly important to the market because they are supposed to give that higher level of transparency. There is debate, however, over, how good they are in general. Typically, people depend on them a lot, so you would think they would be pretty good in general. But we also note that there's going to be some kind of there's only 3 big players in terms of the rating agency, so you got a lot of consolidation and less competition, and that sometimes could lead to problems if there's a problem with any one of these basically big institutions. And we did have the mortgage crisis that took place that they didn't really pick up, where the banking industry was rating securities probably higher than they should be, and there's questions as to whether or not that should be caught or not. So you could question whether or not these rating agencies are, how well their ratings are tying out. but of course they are going to be a key component for people to depend and make decisions on when investing. So we've got the three main agencies. We've got Moody Investor Service, we've got the Standard & Poor's Corporation, and we've got the Fitch Ratings. So the Moody's, if we look at Moody's, has 9 rating categories. So if you're looking at the corporate bonds, then you're categorizing the corporate bonds to see, how dependable they are. So the rating categories go from A, they usually categorize it by a large A and then 2 small A's, and then an AA with a large A and a small a, and then an A with 1 capital A, and then a B, capital B, 2 small A's, and then a B and a small a, and then a capital B, then a capital C, 2 small A's, the capital C and 1 small a, and then finally a C. It also has the numerical modifiers of 1, 2, and 3 that will be used. Now, obviously, if your ranking category goes down, if Moody's comes in and says, hey, you were at a higher ranking category, and we've now said that due to whatever factors that are taking place, you've taken on too much debt, for example, or something like that, we have downgraded your rating, then of course that means to the market, that's a signal to the market that Moody's is saying that there's more risk that is involved in these bonds, and therefore the market's going to want a higher return to invest in those bonds, would be the general idea. So, and this could apply, you can apply this to basically countries as well when you're talking about countries issuing debts, states issuing debts, company or corporations issuing debts. The question, what would happen, obviously, it would be a bad thing if you're saying, oh, I'm on a really high rating, and then they knock your rating down. Well, all of a sudden, that would mean that it's a whole lot more difficult to get financing. The rate to cover the financing would go up at that point. So that would not be good typically. And then we have the Standard & Poor's Corporation. They have a similar kind of format, but with capital. So you'll have this similar kind of lettering format, but you can see that it's Standard & Poor's because instead of this capital then lowercase that Moody's has, it'll typically have all capitals, and it will also use a plus and minus for the modifiers instead of the 1, 2, and 3. The Fitch Ratings is similar to the Standard & Poor's. So here's just a table on the left-hand side, just a quick example of these items just to get a feel for what it might look like. So the bond with the higher ratings will generally have lower risk and lower interest payments. So if you're looking at very stable bonds that have a high rating, then the fact that it has a high rating means you're taking on low risk when you're investing in those bonds. Because you're taking on the low risk, the market is usually people are usually willing to invest in them and still get a lower amount of return. So you're probably going to get a lower return. That's that risk and reward relationship. You just want to make sure that when you're thinking about the risk and reward, you're balancing those, properly. In other words, again, you're not looking for just because the risk goes up doesn't mean the reward is necessarily going up. You got to make sure that those things kind of tie together, and the market indicators should kind of help with that because that the market is trying to weigh those things out, the risk and the reward. So with a bond with a higher rating, we'll generally have lower risk, and then it'll have lower interest payments due to that. So the true return on a bond is measured by the yield to maturity. So the yield to maturity calculation, bonds that have the same rating and maturity could still be sold at different prices depending on coupon rates and yields to maturity. So if you're looking at 2 bonds and you're saying, hey, these 2 bonds are both at the same rating level, then you still could have differences in the prices because there could be differences in the coupon rates. So you could have the same rating, they are of the same rating, but they have different coupon rates and they have different yields to maturity. That is another factor that will be taken into consideration, and that will obviously cause differences in the price levels.